Most people think investing is about finding the right stock. But the truth is, most people fail because they start with the wrong behavior. I study how everyday people build wealth slowly, consistently, and without guessing the future. No trading tricks. No hype cycles. Just simple systems that work over decades. And today, I want to show you exactly what I would do if I had to start investing from absolute zero in 2026, with no connections, no luck, and no shortcuts. Let's be honest about where most people actually start. They don't start with extra money. They don't start with perfect timing. They don't start knowing what a stock even is. They start tired. They start confused. They start late. Maybe you're in your late 20s, 30s, or 40s. Maybe you've watched markets go up, crash, recover, crash again. And every time you thought, I should probably be investing, life got in the way. Rent increased. Food got more expensive. Something unexpected happened. So instead of starting, you waited. And the longer you wait, the heavier that mental weight becomes. You start thinking, I missed the good years. Everything is already expensive. I should have started earlier. But here's the part nobody tells you. Feeling late is normal. Starting imperfectly is normal. Waiting forever is the real mistake. The biggest lie people believe about investing is this. If I don't start big, it won't matter. That belief alone keeps millions of people permanently stuck. Because when you believe size matters more than consistency, you wait for the right moment. A raise. The bonus. A calmer life. And that moment rarely comes. Let's talk numbers. The average American has less than $5,000 invested outside of retirement accounts. Globally, the majority of adults don't invest at all. Not because they can't, but because they overestimate complexity, they underestimate time, and they believe they need to be good at money first. But investing doesn't reward intelligence. It rewards behavior. A person who invests $300 a month for 30 years at a modest 7% annual return ends up with over $340,000. That's not luck. That's not brilliance. That's math. And here's the key insight. Most people fail at investing before they ever invest a dollar, because they never build a system. So let's wipe the slate clean. Imagine I wake up tomorrow in 2026. No portfolio. No insider knowledge. No head start. A regular income internet access and the same global uncertainty everyone else feels. Here's exactly how I'd rebuild, step by step. Step 1. I'd fix my financial floor first. Before investing a single dollar, I'd stabilize my base. Not perfectly. Just enough. That means 1 month of basic expenses in cash, a checking account that doesn't constantly go negative, a simple budget that tells me where my money actually goes. This isn't about being disciplined. It's about removing friction. Because investing from chaos doesn't work. Studies show that people without emergency savings are far more likely to sell investments at the worst possible time. Not because they panic, but because they need the money. So this step isn't optional. It's defensive. Step 2. I'd start with boring, broad index funds. If I'm starting from scratch, I'm not chasing returns. I'm chasing survival and consistency. That means broad U.S. market index funds. Total world stock funds. Low fees. No predictions. Something like a total U.S. market index. A global ex-U.S. index. Or a simple all-world fund. Because here's the truth. You don't need to beat the market to build wealth. You just need to stay invested. Over 90% of professional fund managers fail to beat the market long-term. Not because they're bad, but because costs, taxes, and timing work against them. Index funds remove guesswork, ego, overtrading. They let the economy do the work. Step 3. I'd automate everything. This might be the most important step. I'd automate contributions, rebalancing, increases over time. Because motivation fades. Systems don't. Every month, money leaves my account whether I feel confident or not. That's how consistency is built. The biggest enemy of investing success isn't market crashes. It's decision-making. Automation removes decision-making. And that alone improves outcomes dramatically. Step 4. I'd ignore the news, on purpose. If I'm starting over, I'm protecting my psychology. That means no daily market checks, no reacting to headlines, no doom-scrolling financial content. Because the market doesn't reward attention. It rewards patience. Investors who trade frequently earn significantly lower returns than those who trade rarely. More information doesn't make you smarter. It makes you reactive. Step 5. I'd increase contributions slowly. I wouldn't start aggressive. I'd start sustainable. Then every raise, bonus, new income stream, I'd increase contributions by small amounts. Not because it's optimal, but because it's realistic. At some point, usually a few years in, something changes. Not the market. You stop checking balances. You stop obsessing. You stop feeling late. Because you're no longer hoping. You're participating. And that's the moment investing starts working psychologically. Step 6. I'd stay boring for a long time. No options. No day trading. No once-in-a-lifetime opportunities. Broad exposure. Long timelines. Boring scales. Excitement doesn't. Step 7. I'd let time do the heavy lifting. Compounding isn't dramatic. It's quiet. Invisible. Slow at first. Then powerful. But only if you give it enough time. Most people overestimate what investing can do in 1 year. And underestimate what it can do in 20. Wealth isn't built by being early. It's built by being consistent. Starting in 2026 isn't late. Waiting until 2036 is. If you want more calm, realistic breakdowns like this, no hype, no pressure, you can subscribe if it helps. And if you're just starting, you're already doing the hardest part.